Well, Tyler, stock market records, which we're talking about today, are made to be broken. We think that the economy is showing good resiliency. We should see earnings growth start to resume into next year. Add dividends and buybacks, and you've probably got a mid to high single-digit return for the equity markets over the next 12 months.
All right, and Lori, you're a little more cautious. You see zigging and zagging through year-end. Your price target on the S&P is a little lower than it is today, actually.
Yeah, so we consider ourselves to be pretty neutral through year-end, and we've said don't rule out another pullback before year-end. If you look at what we've seen this year, it's essentially a rally off a growth scare low that we put in last December. And when we've seen this in the past, off the 2010, 2011, 2016 lows, we've tended to get quite a few pullbacks of the 4 to 10% caliber. So we think we could be setting up for another one of those.
The pullbacks cause would be?
Well, we don't like valuation. So that's the first thing that we've been pointing out is if you
too high.
Too high. And what we actually pointed out last week was if you look at the forward PE multiple, we're actually starting to bump up against getting pretty close to levels that we've peaked out previously in this cycle. And we've seen that already on other metrics like price to book and price to sales. So what you have to assume is the good news and, this list that we just went through, the healthy consumer, some progress on the trade war, we think a lot of that is already baked in.